Welcome to Pierpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Pierpoint Perspectives is brought to you by the consulting team at Pierpoint Financial. So now, over to your hosts.
Hello and welcome to another episode of Pierpoint Perspectives. I'm your host, Zimmerhansl, and practice lead at Pierpoint. When we talk about securities lending, the conversation often focuses on hedge funds, short selling, and a parade of acronyms such as SFTR, LCR, and others. But to be honest, most of the business is about operational processes. The focus of today is a dive into the operational side of the business, and I'm joined by John Arnesen, who runs the consulting practice at Pierpoint. Good morning, John.
Good morning, Roy.
So, John, first, why is this episode important for listeners and who is it targeted at?
Once a trade is executed, the work really begins. So I'd argue that if your service loans as your primary responsibility, then you will either disagree or agree with what we're going to say today, but you will find it familiar. If your primary function is trading or management, then it's the efficiency of how your loan transactions as a service that can make all the difference to your bottom line. It could also make you a differentiator in terms of prospective clients. So for that reason, I think the subject is important.
Great. So what I'm used to doing over the years is talking about front office and back office as a means to delineate functions and tasks. But in recent years, we've really started using phrases such as post-trade, which has become popularized by the vendors that service the industry. In one of our earliest podcasts, you said that there's no such thing as pre-trade or post-trade, and I found that really interesting. So I want to revisit that. Are labels such as front and back helpful?
If you're the donkey in a pantomime, I know which end I want to be. So the idea of the words front and back over the years have a negative connotation to some extent. And as you mentioned, we've replaced some of those words. Essentially, I don't think we're going to get participants to particularly change the language they're going to use. I prefer to use terms like trade and trade support. And the reason for that is there is one loan life cycle, and the participants that service most of that are not those that execute a transaction. After that's happened, the work really begins, as I mentioned. And every day of a loan, it is subject to a number of variable factors such as price movement, which will lead to a mark to market. You may end up with a partial return. You may need to re-rate the transaction. And that, of course, then the seasonal effects of maybe manufactured dividend payments come into the mix. You could have an event-driven corporate action, which requires some real manual intervention. And lastly, of course, you may have to recall the transaction or reallocate it, which requires action by somebody in some unit. All of these events create friction in the transaction. And so it's the degree of automation that can be applied to these functions that reduce that friction. And that is where this industry needs to focus its time, resources, and attention. Mostly because you're going to end up with regulation that's going to force this on you to some extent. And secondly, some of these functions are proving difficult to automate, and we'll come on to that later. You have to ensure, lastly, and this is critical, that your books and records, with having performed all the functions I just mentioned, are absolutely in line with each of your counterparties and remain in sync for the lifetime of that loan. Otherwise, you are asking for all kinds of problems later down the line in terms of settlements of returning transactions possibly, and of course at the end of the month you have the billing issue, which if that isn't correct can consume many man hours in trying to reconcile.
It's interesting. While you were describing that, it made me think that, well, back to days when I've talked about back office, right? You talked about reallocating loans or covering recalls, and I was thinking to myself when we were at Deutsche Bank many years ago and we automated some of the trade execution side of things, we gave our back office people the ability to cover general collateral trades. And in my own mind, I was thinking along the bias you just talked about, calling it back office as a negative connotation, when in fact, I meant that as something really positive, because when I look at it now, I think of trade executors and then trade managers. Rather than front and back office, you've got people that make the trade happen in the first instance, but most of the work that you described really happens afterwards, and that's managing the trades from execution point until conclusion. So that's quite interesting. What are your thoughts on the trade management versus trade execution side of things?
I think that's a very good way of putting it, actually, and it's kind of what I was really trying to get across. I think it's important, though, to recognize that there should be a segregation of responsibilities to ensure that certain functions, for example, aren't permissible by one party or the other. We live in a highly regulated environment these days, and it's likely that you'll have reporting lines for, say, the trade management part of it, perhaps reporting completely outside of the business unit. And that may be actually quite appropriate. It doesn't mean, however, that the responsibility has shifted with it. So trade support or trade management certainly works for the trade execution part of the business, even if they may actually end up reporting elsewhere.
Yeah, and that, again, just to clarify what I meant, in case there's any listeners out there that think there was a problem with segregation of duties. What I meant was when we had recalls, that the process of managing, covering those recalls became the responsibility of a trade support unit, and they would look at it, make certain that any recalls went into the automated execution process, and any trades that couldn't be covered in the trade automation side of things were then passed back to the traders for covering, because almost by definition, they wouldn't be GC trades.
Do you think, though, that in this environment, Roy, that even a trade recall or reallocation would be considered a transaction and therefore needs to be executed by the trade execution staff? I hear what you say, because many, many years ago, I mean, this is even before SEC financing really took off in the late 80s, 90s. I knew that a lot of auto or borrowing from Euroclear, for example, for fixed income transactions was done by an operational area. You looked at what was failing, and you actually had to find out from Euroclear if it was available to borrow, and then you put in the request. I don't know that those functions in this environment continue as you described.
Yeah, it'll be interesting to see, and I always invite listeners to give us their thoughts and comments. I think it's an interesting area. Now, one of the things that leads on to, as you talked about, was this idea of segregation, of allocation, of responsibility. And I'd like to actually extend that out to the other point you made, which was reporting into different areas. And I think the best example of this might be outsourcing. So probably as far back as banks started talking about downsizing, and then it became right sizing, and then after that I think it was smart sizing, but all of those were just presumably more palatable labels for outsourcing and the concern over jobs. So there's been a trend for maybe 20 years. In your view, has pandemic changed the appetite or the focus for this?
I think it remains to be seen. But what the pandemic has done is apply an event to all of you at the same time. So typically you had one of the reasons for outsourcing, apart from the obvious cost saving that occurred when people really started to think about the sheer size of having groups together in locations that were probably expensive. That trend continued for many years, and we know that lots of that ended up in Asia. Some of it ended up in regional parts of the US and even the UK. But that was also a contingency which I think came out of 9/11, which was don't be too close to each other in case you can't operate. What the pandemic has done is said none of you can operate. And I'm wondering whether that is now going to have a rethink of the purpose of having different locations beyond what was the original drive, which was cost saving. I no longer think it's that. And I also think that it's going to give rise to questions about cost saving is one thing, but quality over quantity. How much skin in the game do you have in the locations that you outsource to? You've got so many things to consider when you do that. You've got to understand how robust the infrastructure is in where you're putting these locations. Are the lights going to stay on if they have an event themselves? I mentioned that some of this activity occurs in Asia. Well, that could be subject to cyclone or even weather events. I mean, I can tell you a horror story that we had a couple of years ago with some severe flooding in one of our outsourced locations that they couldn't get into the office or even to their backup site because they're both underwater. That is going to come into the mix when you're considering how to do this in the future. I'd also go as far to say that if you're really going to do this for solid reasons in terms of separating functions in the event of an event, perhaps it's also worth considering having more than just trade support functions in those locations and perhaps putting trading or a limited amount of trading with them. Local regulators are increasingly, I believe, asking organizations that do this to understand what functions are you putting there? Are you taking it seriously enough where you have real managers, real risk officers to oversee the activity? And I think that isn't a bad trend. I think the question of geographics is also important. Trying to move functions out of, say, the City of London to other parts of the UK may or may not have an economic factor that is favourable. In a country like the US, where you have regional differences between, economic ability or unit cost, for example, it may be easier to do so. And also, you don't carry this country risk that I described when you do that. For example, if you're moving to the Southwest or to the Western states, if you're in New York. I think country risk is also a consideration in terms of how politically stable is the location that you're considering, and could that be subject to shocks as well? For example, in '98, you may not have wanted to put your activity in Malaysia. So I think the jury's out, right? But I think there'll be a fair amount of new approach to this to determine what we've learned from this pandemic and whether that does require changes in the future.
John, can we now turn to, after having talked about fails, can we now turn to recalls? The right for a beneficial owner to sell securities that are on loan, to me, is a fundamental prerequisite for institutions participating. I don't think an investment manager would agree to make their securities available for loan if they didn't have the right to continue to trade them. So that makes it a necessary function of market practice. With the next phase of the central securities depositories regulation on the horizon, there's a heightened concern that securities lending is going to expose these clients to the costs and reputational damage that result from buy-ins. So in your view, what do you think the market should be doing in preparation for that?
This is the first time that what has largely been a self-regulated or self-resolution event in terms of failed transaction is going to be taken out of the hands of the participants, and that has to cause some concern and requires some attention. When you think about what causes a failed transaction for a client, I'm only talking about when a client has sold a security, because this goes to the heart of how you sell the product in the first place. We always talk about the seamless nature of it, that it happens behind the scenes, it doesn't interfere with the investment management process, etc. But the reality is, every time a failed transaction happens to an asset manager, it does interfere with it, and the consequences of that can be far-reaching. I think the industry is going to have to look at what is the likelihood that you won't get a security back. I mean, ironically, the more special a security is, the less chance you have of getting it back on time. I think it starts, Roy, with a lot of data crunching. I think you need to look at the assets that you have to lend. I think you need to do a fair amount of analysis as to what is the typical net bottlenecks in terms of those securities. How special do they get? And how often have you had to recall them? which of your clients tend to do you have to recall for more than others? Bearing in mind, though, that you've only having to recall if you have exhausted every other possibility. And by that, I mean, can you reallocate the loan to another client in your program? And by that, you need to look at, do you have a concentration of certain securities with certain clients? Once you've exhausted all that data, then you come to a decision about how you're actually going to behave. It may lead to holding back greater buffers, if you like, in anticipation that this may become an event. That can lead to complications as to, well, how do you come to that decision? Are you keeping your clients fully transparent in why you're doing that? And that's, of course, making the assumption that you have the ability to recall. When you have segregated accounts outside of an omnibus structure, you may find it very difficult to reallocate internally, because you may need to actually move the security back from the borrower and then re-lend them a security from another account, which is a massive pain if you think about it. If that's happening, you may find the borrower isn't interested in doing that. And then, of course, you end up with perhaps being out of sync with where the loan's coming from and going back to. Whatever the outcome of this is, there is going to be a heightened focus on this from the underlying clients. So I think the market has done a fair amount of work in preparing for, as you said, CSDR, to the extent that they can. The outcome won't really be known until this goes live, bearing in mind that there is a 4-day sort of window of where you can repair the failing transaction. And according to ISLA from last year's, a document that they published last year, I think the figures in there were 95% of securities settle on time. So it doesn't sound like we're talking about a huge issue, but it only takes one security to fail that causes a problem with a client that is so sensitive to it, it can have a disastrous effect on their participation. So I think it's something you must take incredibly seriously and do as much as you can to work out why it's happening in the first place.
One point you mentioned I wanted to pick up on is we talked about beneficial owners. So in my question, originally I talked about beneficial owners, and you described the impact on beneficial owners. But is it more complicated in the scenario where you have a beneficial owner who employs multiple fund managers, because really the interaction and the notice of fail doesn't really go to the beneficial owner? It's the fund manager who feels the brunt of it, and often they aren't in any way compensated in the securities lending arrangement. So for them, it's even more work. Is that present any additional complications or challenges?
I think it does, in the sense that you've highlighted a very good point, in that whilst the beneficial owner has appointed you as their, let's say, agent lender, the fund manager goes along with it, for want of a better word. They accept that it's a function that their client wants. But of course, the fine, if it came to a buy-in, would go to the asset manager. So I think you're going to have a lot more of the kickback and the concern coming from the asset managers in general. But in turn, of course, they have to also report back to their underlying clients, and a disproportionate amount of failed transactions on the back of securities lending is going to be highlighted to their clients as well. So the work really should be between the asset manager and the custodian bank that's lending the securities, and having an understanding of their activity and the likelihood of, as I said, mentioned before, what's their trading pattern look like, and if they're a passive fund that hardly ever sells, so be it. But you make the point correctly that it is them that will bear the brunt of the restitution of a failed transaction.
And I can tell you all kinds of stories about my interaction with fund managers over the years. Any sort of thoughts or suggestions or stories you want to tell us about your experiences with portfolio managers who, again, can bear some of the direct impact of it, but may not share in any of the economics?
Not that I can do outside of an X rating.
I think
I've had asset managers scream at us for a failed transaction because their counterparty was such that they were selling into an entity that wouldn't tolerate any kind of. They put a relationship with a very important client on their side at risk because of our activity. And when we actually did the analysis as to why the transaction failed, it was because the asset manager's instruction was wrong, which kind of got off the hook. But I think that the salient point here is that this is a very important part of the function of securities lending, and it may reside within the trade support area. But if this isn't at the forefront of the manager's thinking at all times as to the reputation that they may be causing somebody else, then they need to start thinking about that very seriously.
And I might take it even a step further, because rather than simply work towards better communication to ensure that maybe trades are communicated on trade date or the next morning or as soon as possible, I think there's a little bit more, because inevitably there are potential fails and there are potential buy-ins and there are often grace periods within specific markets, but it requires interaction. So let me give you one example. We went not long after I moved to Hong Kong a few years ago, one of the portfolio managers for one of our clients sold a position which was equivalent to 1 month's trading volume. So and it was trading reasonably special in the first instance. So it was a challenge. And we started working through, and you go through and you start doing partials and you see where you can substitute it, and you give the borrowers a notice as soon as you can so they can start scrambling around. Of course, everyone searching from largely the same pool of replacement assets. And we started getting partial positions being able to cover it. So if, for example, let's say it's 1 million shares, we could get 100,000 shares covered by a borrower and replace that and make a partial settlement. And the problem we encountered was the operational infrastructure between the custody team who was making the market settlements and the portfolio manager who'd instructed a trade for 1 million and now was being asked to do a partial for 100,000. And just the process of getting them to agree to split their instructions. So first of all, my company needing amended instructions. Can't be 1 million, has to say 900,000 and 100,000. And the fund manager, who again, for them, it's just work, now has to amend their instructions. And so there was a real challenge there. Now we got over that challenge, and in the end, they cooperated. The 100,000 shares got into the market. That settled part of it, which then went through the cycle and got reallocated along the way, and the borrowers were able to borrow more and more and more, and it kept getting recycled. Ended up not having a buy-in, but it was a frantic few days with lots of stress. So was that just a one-off, or does that happen once a year, or do you see this as being more likely to happen in future?
Let me ask you whether the asset manager knew that he was part of a lending program when he made the 1 million sale.
So that's a great point. By implication, you're suggesting they don't always, and that's true. In this particular case, they did know that they were part of a lending program.
You see, this is a two-edged sword for me, Roy, because on the one hand, we do claim that securities lending happens behind the scenes, that is not interruptive to the normal cycle of an asset manager's activity. And yet here's an example where, knowing that he was selling she was selling for 1 month's trading volume at one time, and knowing that the security was maybe on loan, could have taken a different approach in terms of looking at the amount on loan and maybe breaking up the transaction into different pieces. That's going to be rare, though, I have to admit. And you asked how often this happens. It doesn't happen with a huge amount of frequency, but what does happen with frequency is having to go back to an asset manager to say, can you change your transaction because it will ease up the market? Because largely they're reluctant to do so, and I think that's fair. They have no, if they aren't privy or party to the activities of the agent lender and they don't receive any revenue from it, barring the fact that they could receive some if they chose to, but in some ways we're sort of breaking our own mantra in saying to asset managers, it isn't always completely transparent, and at times we're going to ask you to do certain things for us. Now, whether that's going to increase as we approach CSDR next year remains to be seen. I suspect that it might, but it might for good reason, because everybody now has more interest in avoiding these scenarios in future.
Right. Yeah, and it was interesting. I tried to get another interviewee on to talk about the reasons why the buy-in element of CSDR might be a problem for the market, but they declined on the basis that they've been talking about it long enough, and it doesn't look like there's going to be any change. So given that there's unlikely to be a change, we just have to get on with it and accept it. So, John, I really want to now maybe go back to one of the points. Again, I think it was episode 2, you kind of dismissed the idea of not only front and back office, but also pre and post trade. You just talked about it as a life cycle. So the rise of and the range in, I'll still call it post trade services, has, I think, dramatically changed the industry. What is your thinking about the observations you have on how it's changed the industry so far today, and maybe where do you think it's likely to go in future?
The change that's really come about over the last 15 years or so is really the rise of vendor support systems that enable a fair amount of automation. And it's the application of those systems that have helped with the increase in volume. And let's say there's been two elements to this market in the last 20 years, between 2000, let's say 2007, and then 09 onwards, because obviously we took out a lot of volume from this market, which has failed to really return. And there's all kinds of reasons why that may be the case. I think the market's in much better shape than it has been. I think if you look at the functions that are performed by vendors such as Pierpoint or Equilend in the post-trade services they offer, if those applications are used, I mentioned earlier about keeping in sync with your counterparty. Well, if you use those services of those two, I'm just using those as examples. If you did use those services and you're both maintaining your discipline, then you will greatly reduce the operational burden that you face. That may lead to having staff that have capacity to do other things. I'm not using this as an example of how to reduce cost, but reducing cost to me, I think the cost is fairly stable. But you're going to have a whole number of new functions that must be performed starting in July with SFTR. That, I think, is largely going to be in the area that we're talking about. It could be a completely new unit. I don't know how certain organizations will decide how to go about this. But I did speak to somebody last December that was gearing up for SFTR is supposed to be, a regulation where you match every single day and report the day after. He's gearing up to hire a whole bunch of new people to do his SFTR reconciliation prior to the report going out, because he knows there's going to be mismatched transactions. And how do you solve that to start with? It starts right at the trade execution. Why do errors occur when you're booking a new trade? And there's a list of them, but if you have those things right to start with and you maintain them, and the errors we're talking about are the ones that are tasked to maintain them, then your SFTR will be much cleaner. And yet, ironically, something that's supposed to be highly automated is going to cause a lot more bodies to be thrown at the problem because of the nature of I think it's the reduced time you have to get this right, and coupled with the fact that SFTR is requiring so many fields to be matched, it's sort of shaken up an area that is doing this purely as a post-trade service. Or the smart money to me would have been on to shake up your trade input process and fix everything of those fields as much as you can, have those fields populated at the time of execution. But that's going to be a whole nother podcast, right? Because I don't know, the jury's out about how people went about that. I think largely it's all hands to the deck, and it was done purely to find out how to get this reporting done.
So as with quite a lot of regulatory implementations in the past decade, it's been more a case of let me focus on what's the minimum viable response to satisfy the regulation rather than what's the optimal approach to resolving and addressing it.
Yes, but I have sympathy for that approach too. Everyone has resource limitations and time constraints, and that wasn't the only thing they were probably working on. But at some point, that will prove to be insufficient because this thing isn't going away, and it's a daily activity. And you may have found a way to get it done to the best of your ability, but there has to be a high matching process at some point, even though there may be more of an attitude at the moment from the regulator that's imposing this to give some break due to the pandemic for, let's say, the remainder of this year. But there'll come a point where that won't be tolerable. And if it's been built just to get through it, that may prove insufficient in the future.
Great. And I think that might be worth revisiting maybe 3 months or 6 months after go live, just to do an interim check on how things go. So maybe you can bring that back to us. So John, I think that kind of forward-looking view is a great place to end the chat. Are there any closing thoughts or comments that you'd like to leave listeners with?
One thing we didn't discuss, Roy, which I think we could do, is the subject of natural failed transactions. We talked about recalls, which are important because they're triggered by the sale of a security that requires you to either substitute it or recall it from the borrower. But a natural return happens because the borrower is no longer in need of those securities because they've flattened their book or whatever reason, or the trade has now come off, and so they naturally return to you as a borrower, as an agent, and you settle them. But when they fail, you could argue two things. One, why do you care? Because you're still making fees on those trades. But it's still interrupting a process which you've booked. So you've booked the transaction to return in good faith, and then it doesn't return. So now, as I mentioned earlier, you've now caused friction for in an area that has to now maintain this, find out why it's failed, maybe even adjust the sort of books and records of the trading desk to say, yeah, it's not on loan anymore, but it's a failed transaction. And then let's say it goes special. Now, can you rate change that failure? Yeah, I think you probably can. But I think you'd rather, as an agent, have that thing settle. Many years ago, when interest rates were fairly steep, we used to make a lot of money out of natural failed transactions because obviously on the fixed income side, rather than the equity side, you close the transaction on the due date. And if the borrower failed, well, then you made the cash proceeds overnight back in 2000, it was 5.5%. That's no longer the case with interest rates where they are. So I think the motivation to be disciplined about this has probably waned to a large extent from the borrowing community. So I think there needs to be far more discipline around when you say you're going to return a security, why is it failing? If it's failing because it's insufficient in the marketplace, in other words, there just aren't enough securities around, well, that would make it rather odd because let's assume it wouldn't be special because why would you be returning a special? And it makes me always a bit suspicious as to if it's not just an error in the booking, well, you can fix that within 24 hours. But if it persists to come back from loan and yet the borrower called it in naturally, I think I want to rate change it. Now, that's probably going to be quite controversial, but there has to be something whereby both sides suffer some penalty for what does cause a sort of irritation in the natural process of things. I mean, the Fed settlement in the US imposed a 3% penalty some years ago, and failures in Fed settlements became almost null and void. I'd like to see something like that for both parties, where it's an agreed part of the GMSLA, for example, that there's a flat penalty in any currency of X to ensure that both sides are kept disciplined in their activity.
Well, that's an interesting suggestion, John. So I quite like some of that idea. I think the challenge you're going to face is that for a borrower, they'll look at it and say, okay, fair enough, as long as it works the other way as well, where a lender that has agreed to lend me stock that fails to deliver it is also penalized.
Absolutely.
You have the potential for penalizing beneficial owners who do this on an optional basis. Do you think that will work reciprocally?
I think it has to be honest to it. I mean, you're right in terms of a lender fails to deliver on the settlement date because he makes an operational error. Now, what happens at the moment is the loan just starts that day anyway, and you well, not on a fee basis it doesn't, does it? It starts the day late. I'd like to see, I think it has to be applied on both sides. And then it gets into a greater discipline around notification of a number of things. Are you being notified in time? Are you putting your instructions in very quickly, et cetera, et cetera? It won't be for everybody, but what's going to change processes that are highly automated now? I mean, I would argue that most participants are using a form of STP where the loan simply, you click a button and it settles. It goes through all of its process internally and it settles out in the marketplace. That allows for a huge amount of volume to go through. The minute failed trades come back, or don't come back rather, and they occur, you've interrupted that process somehow, and therefore somebody's going to have to address it. And it's going to be somewhere in the trade support area that's taking up their time and effort. Now, that's the way things are at the moment. I'd like to see a change to that, and I don't know quite what the answer is yet. But this does give rise to the fact that if it's the borrower that put in a very sloppy instruction, you've now caused the agent lender's operational area to incur some effort, but without compensation, and I don't think that's fair or right.
Well, John, this episode was to talk about the operational framework for the industry. I think, interestingly, we're kind of wrapping up on what could be a controversial suggestion in terms of having two-way fining or penalty mechanism. I think it'd be really interesting. It could create for a borrower another differentiator where they say, I will deal as a preference with lenders that commit to this two-way road, where if I fail to return assets that I've said I'm going to return, I'm penalized. But you know what? If they fail to give it to me in the first place, they're also penalized. And that kind of discipline deserves a premium, I think. So a great place to finish. Again, one more chance, John. Anything else you want to add? I think that was a great addition to the conversation.
Well, to follow on your last point, Roy, in a limited market, in a market with a limited amount of demand, and I use that word carefully, but look, face it, the volume in this activity hasn't really increased much over the years. To make yourself more attractive as both a borrower and an agent lender, you have to ask yourself what makes you attractive. And high degrees of automation and settlement efficiency is one way in which you will attract more business. More business means more revenue. So, you can do the maths yourself after that. So I think that is a differentiator. And I think it's an area that, put it this way, if you are sloppy and you're known to be a fairly poor counterparty for a host of things, that is being discussed behind your back without you knowing it. and it will show up. You won't know why it's showing up, but it does. And it probably shows up with less business.
And it's all about grabbing a bigger piece of the pie that's out there. So irrespective of whether the business gets bigger or smaller, the kind of things we talk to our clients about are how do they capture a big enough piece of the pie to be meaningful to them without going outside of their accepted risk parameters. So I think you've summed it up nicely there. And I guess that's a wrap for this podcast. So we've been looking again at the operational framework for the industry. I think John's given us lots of food for thought here on issues and challenges and questions for the future. So thanks, John. Appreciate your time today. Now, listen, to our listeners, we want to provide you with the topics that you want to hear about. So if you have subjects or guests that you'd like to have as part of the podcast, send them through to us. Our contact details will be in the show notes. If you want to hear more from us, please subscribe to the podcast and tell your friends. You can find us at www.pierpoint.info. We're on LinkedIn and Facebook as Pierpoint Financial Consulting, and on Twitter at Pierpoint FC. And again, all of that will be in the description. I'm Roy Zimmerhansl. This has been another episode of Pierpoint Perspectives, the art of securities finance, and I look forward to catching you next time.